So I want to thank everybody so much for joining the Marsh webinar on Grow Your Business with Surety. My name's Nicole Xavier. I'm the Member Services Administration Manager here at CNLA. At this time, I'm going to turn things over to Taylor Edwards from Marsh to get today's session started. And from there, he will introduce Connor Smith.
I wanted to take a moment just to give a bit of an overview of the HortProtect program, which the surety piece that Connor's speaking about definitely folds into. As some background, the HortProtect program and the offering through Marsh has been around for just over 15 years. And what that's allowed us to do is create a program that's very, very much focused on this industry. And what that looks like is what I like to call the four pillars of HortProtect. And that starts with broker experience. That's us participating in a unique and dedicated way with groups like this, with association events, networking opportunities, speaking engagements, and the like, where we can interact with you guys as a group. That also means, working our jobs and interacting with each and every one of the 400 plus individuals that are on the program every single year, understanding and taking a deep interest in everyone's businesses and the way that they operate and what makes them unique. What that 15 years of experience has allowed us to do is also pick underwriting partners. We picked one insurance company and one underwriting team. And why that's important is we can take that 15 years of experience and bring it to an underwriting team, and they can benefit from that in a way that they understand what makes your business unique and why it's important when they're evaluating the risk we bring to the portfolio. That usually translates into lower and more accurate rates, more timely claims decisions, and better performance on the renewal cycle altogether. The third pillar being claims, as that's an intricate piece of everything that we're talking about. We work with specific claims partners. Rather than using generalists on behalf of the insurance company, we work with a dedicated set of individuals on the claims side who also share the same set of experiences that we've brought to the insurance company. So they're well aware of the ins and outs of your business, the importance of return to work quickly, the importance of getting machinery back on the road in a timely fashion to reduce business interruption. So all of that is to say is streamlining the insurance process, making sure the claims piece is as advantageous as possible while de-risking and reducing prices throughout. The last point is ongoing risk management. That's sessions like this where we're bringing in, risk management knowledge back to the group so that overall we're increasing all of our knowledge of risk management, de-risking businesses across the industry, and hopefully coming full cycle by minimizing claims, and the stigma that this industry is claims prone altogether will be reduced. So with that said, I'd like to pass it back over to my colleague Connor to continue the presentation on surety. Connor?
Great, thanks, Taylor. Just before we jump into the presentation, I really like this slide because it speaks to what we do in surety as well. While it may not be as structured as the HortProtect program, our surety philosophy, the way that we engage with our clients, really fits into these four buckets quite well. Kind of reaching to that final stage of risk management where our team is also working with Taylor and his colleagues to bring in that level of knowledge from an insurance perspective to accommodate and support our clients in their risk management pursuits. So just to quickly go through it, extensive broker experience. We have clients, we have folks on our team with significant underwriting experience, which we'll get into. We have that underwriter specialization and dedicated claims management. So, as this HortProtect program is specific to the association, it really speaks to the fabric of Marsh across all our lines of business. So, just wanted to jump that in before we kind of kick things off on a more surety specific basis. So, yeah, Connor Smith, I'm our national surety leader for Canada. I support our team across the country. We have 40 individuals from coast to coast, folks from Halifax, St. John's, all the way to Vancouver, and everywhere in between. So we have an extensive footprint across Canada where we support contractors, small and large, both in the construction segment, also in commercial surety. So that would be more what we would attune to kind of snow clearing contracts and so forth. A real holistic approach to our offering in surety. My background, and similar to a number of my colleagues in Canada, I am from the underwriting side. So before I joined Marsh, I was the national surety leader for a large global surety for Canada, supporting our growth initiatives for the contract surety business, which is construction primarily, in addition to the service aspect of construction across Canada, where we were growing that book of business from coast to coast as well. Prior to that, my experience goes back to another surety company, so a lot of extensive experience, primarily in the Greater Toronto and Ontario area, but certainly across the country from coast to coast. So we'll jump into it. Just a quick agenda. Just wanted to just kind of level set initially, just with a kind of a brief description of surety for those that may not have utilized the product before, have familiarity with the product, and how to utilize it on their projects. We'll just kind of go over that, and we'll actually look into some of the evaluation criteria that our underwriters are utilizing, how they're looking at firms, what metrics they're looking at, what financials they'll be reviewing, and how they're reviewing them, more importantly. As we kind of proceed, looking at how we can kind of expand your facility, if you already have an existing facility, how we can improve that bond capacity, and how that can really, at the end of the day, help your business grow. That's the key part of this. Being a surety qualified contractor is a differentiator. We want to make sure that comes through and gives you the opportunity to grow your business and do it in a holistic and supportive manner with your risk management partners. So just to quickly jump into kind of what surety is defined in the most simple state, it is a guarantee of performance, right? So while there are a number of bond wordings that are available in the market, the primary bond that we do see is a performance bond, right? So this is a bond that attaches to a contract, could be a contract, subcontract, that guarantees the performance of that underlying contract, and to ensure that the contractor is fulfilling their obligations and holding true to the expectations of the owner. I say owner, that could also be replaced with general contractor if you're operating as a subcontractor. Could be a subcontractor if you're operating as a supplier. So there's many facets of the industry that have the ability to secure themselves with a performance bond, and we'll get into that a bit later. Really, the crux of a performance bond, what does it help do for an owner or a general contractor? Well, it does pre-qualify, right? So it provides that assurance that the contractor they're contracting with is qualified to carry out the project, and support the overall completion of that work. Really, the background of the underwriting is quite extensive. You kind of consider it almost like going to the bank, qualifying for a mortgage, a line of credit. The surety company is digging in quite thoroughly to review both financials, past experience, management, and we'll talk about that further as we go along as well. And as again, the other part of this is obviously the security aspect, which does provide that financial protection against the loss on a bonded project when a contractor does default. So really what we're looking at here, it is a three-party agreement. While the contractor is the one securing the bonds, going to their broker, requesting those bonds, getting them from a surety company, the actual beneficiary, the one that's going to benefit from that policy, is the end owner, right? So that could be a municipality, that could be a private owner. It will not be the person that is actually requesting the bond. They're utilizing that as a tool in order to secure that work, right? So a little different from insurance, where this is a three-party agreement. This is a two-party agreement where the beneficiary is that top obligee owner, the person that is requesting that bond, right? So in order to support that job. And again, as was mentioned earlier, if there's any questions, there is a Q&A panel. Feel free to jump in and ask away. So for a principal, for a contractor, you'll hear the word principal utilized quite a bit in discussions with surety. That is actually the contractor position. There's three positions. You have the obligee, which would be the owner, the principal being the contractor, and the surety being the insurance company that's supporting it. So what are those benefits for the principal, for the contractor? Traditionally, when you're looking to secure a project, we've seen letters of credit being utilized. This is a balance sheet hit. This is utilizing your bank facility. Bonding, surety is an off-balance sheet security that we provide to our project owners. It's not utilizing your actual net worth. It's leveraging your balance sheet in order to provide capacity and bonding to support your growth endeavors and your needs from a project standpoint. It is a conditional guarantee. So when we look at a letter of credit, it's pretty simple for an owner to just kind of call on that and claim on on our letter of credit. A bond does have a condition with respect to claiming on that, and that does, require full investigation before money is paid out. The surety will review the information that the owner is supplying with their claim documentation to ensure that is a bona fide default before anything is paid out. And in the background of that, there is an indemnity agreement that a contractor would sign when they initiate their facility. So if you think about a surety facility, it does kind of operate in the same sense as a line of credit where you have an aggregate number that you can draw down on a per project basis. It allows you to utilize that line for multiple projects at a time. But within that initial structure, the surety sets up what they call an indemnity agreement. This is signed by the parties of those that require the bond. So it would be typically the contractor, but can also be extended to a number of other parties, including holding companies, personal indemnity. And again, this qualification process is all baked in the financial strength of the entities looking for bonds, depending on how strong that primary entity is, that operating company. The surety may be able to rely on that in its own, but potentially will need to supplement their support with holding companies. For instance, if a property is held in a holding company and not in the operating company, they would want to kind of pick up that net worth, that value add to their underwrite. And again, if there's assets outside of that really need to substantiate their underwriting, they may look for personal indemnity, which would be the personal assets of the shareholders involved in the company. That agreement is also the fundamental foundation of how claims are also responded to in the event that a claim is paid out. That agreement requires the principal, the bonded company that has defaulted on the project, to make the surety whole. So it is, quite a little different than obviously than an insurance product where at the end of the day, the surety company is looking to be made whole after paying out a claim. Certainly, there are instances quite often these days, unfortunately, where contractors do go into claim, and we are leveraging a balance sheet. So the volume of claim activity is in excess of the value of a corporation. And that just happens to go down to the leveraging game that sureties play, that financial institutions play. We are leveraging, right? So, the surety is not just looking to kind of pay out on a claim. They're there as a partner. And I think that's something I want to drive home. That's a critical piece in this. It's not a traditional insurance relationship. A surety company is looking to partner with your organization. They're extending their balance sheet to support your business. They want to be there through the good times and the bad times to ensure good result for them, but also for their clients as well. And when those circumstances play out over time, and when we're looking into claim situations, I've represented clients that we've been able to secure funding from surety companies instead of pushing a claim into a full default or a default into a full claim situation. We've actually had situations where we've allowed the surety to finance payroll, for instance, to kind of get our clients' staff back on the road to complete the work, rather than push this thing into a default where the likelihood of increased costs and concern around fulfilling that obligation are heightened, right? So the surety, again, it's a partnership, and that's something that I think is a critical piece. And when we get into some of the reporting requirements, information that we'll want to share with our surety partner, with our broker, you'll see how it is quite open book, and it really takes a good partnership as we move forward. We talked about LCs earlier. We do see LCs from time to time in the private sector. In Ontario now, for instance, we have mandatory bonding on public work. Anything over 500,000 on a public project requires bonds. There is a gray area, obviously, for private work, private owners. We still do see from time to time LCs required. When it comes to bonding and LC costs, they are quite competitive in nature. So and obviously there's an opportunity cost by taking that credit out of your off your balance sheet. You're utilizing that for something else that we could much more benefit from using a bond in those circumstances. So and again, goes back to the fact that it's a conditional guarantee as well. So there's a full investigation. Just quickly go over kind of the main bonds before we crack on further. At the bid stage, when you're looking at a new opportunity, be on public work primarily, in some private work as well, we tend to see a bid bond request required by the owner, usually in the amount of 10% of the bid price. This is a standard requirement we see from effectively from all public work, municipalities, provincial, federal work. It is a requirement, and it usually comes in addition to what we call a consent of surety, an agreement to bond. An agreement to bond really outlines what the expectations are if that contractor is awarded a project. So the surety is agreeing at the bid stage to issue a performance bond, a labor material payment bond. Usually in Canada, it isn't the amount of 50% for both. And in Ontario, again, that's what we see from a standard perspective over 500,000, in addition to some other jurisdictions like New Brunswick and other provinces are also in review of that right now. Both of these, really, there's no standard wording. There is a standard wording. There is a CCDC wording for the bid bond. We do see some irregularity there from time to time where owners are requesting a certain wording, certain verbiage, but we tend to see the CCDC. When it comes to the consent of surety, there really is no standard wording. The surety companies have created their own, but as I say, it's a very standard document, a very straightforward. Effectively, the surety is agreeing to issue 50% performance bond, 50% L&M bond if awarded the contract. So it's a very, very standard product that we issue at the bid stage as well. Once awarded the project, as we mentioned already, there's the performance bond, which we talked about. In addition to that, you have the labor material payment bond. So this one, I don't think we talked about earlier, but this effectively supports the subcontractors, the suppliers that fall below that prime contractor, or if it's a subcontractor that's providing those bonds, the next level down. In addition to that, in Ontario, the Ontario Construction Act forms allow for Tier 2 subcontractors to actually claim up on the prime contract bond. So there's different layers noted on the bottom there, federal government as well. We call those broad form bond wordings, and they support effectively the transfer of funds, right? I mean, a lot of the changes in the construction acts that we've seen across the country have been, very focused on prompt payment, and it's about moving funds through the construction pyramid is what they like to call it, moving money from the owner to the prime down to the subs in the shortest period of time. These bonds are allowing that to occur. They're supporting that endeavor to ensure that money is flowing. And just to keep in mind when you are looking at these, if you are looking to put a claim in, just make note of the timeframes that potentially could be stipulated within the bonds from a reporting standpoint, a reporting of loss standpoint, but also as the process kicks off, the expectations of both the surety, the obligee, and the owner and the contractor as well if you're a sub-trade claiming on that bond. So just something to keep in mind. Lien bonds as well. Obviously, in Ontario, we just had a transformational change in the Construction Act to liens. Imagine we'll start seeing more of that across the country as well, where we'll see an annual release of holdback. I think that's quite important for contractors that fall into that kind of finishing trade bucket, or on the early side of things as well. Some of the excavation work that needs to be done on projects that are in long duration, ensuring that you're able to get that holdback released in a timely fashion is critical. What we've seen in the past is holdback being held on for a considerable amount of time. We're not looking to do that moving forward on those large projects. We're able to release that on an annual basis. Lien bonds in itself as well, and I should have had a separate slide for the holdback bond, but a lien bond, we see a lot of lien activity in the marketplace. It happens. We can actually release that lien, discharge that lien from the court by putting up a bond, right? So it allows the owner to move on that property, legal right to sell or deal with that property to the owner. So we have that ability to kind of move that, keep the money flowing again on those projects. And again, it just goes back to what I mentioned earlier. Bonds are really supporting the flow of money, if you will. Jump into just kind of how the sureties are are looking at contractors and how they're evaluating. Kind of the underlying premise of surety underwriting is what they call the three C's, that what they're looking at. It's capital, capacity, and character. Obviously, capital being the financial strength and working capital of the firm. Capacity is the ability to perform the work, and character is reputational integrity and that track record, right? So they're really diving in. It's not just about the financials. Certainly, there is a weighting that is heavy on the financial aspect of it. If you do not have the financial capacity to complete the work, I mean, they're going to have a tough time getting over being able to support your facility, even if you have the other two. It's not a two out of three equals success. You need to have all three, and they're quite adamant about that. As we mentioned earlier, it is a partnership, and that's where that character, that reputation, that integrity piece really comes through. They want to know the person they're partnering with is going to stand by them in the event of a claim activity that does present, that does name them in an issue, right? So the project continues. They want to make sure that those people are there to support to their best ability the completion of that work. So, and then capacity, I think that speaks for itself. Do you have the equipment? Do you have the manpower? Do you have the resources to complete the work you're looking at? And again, I think this is all on a scale. So depending on the size of work, the complexity of work, these underwriting conditions do tend to change from time to time in terms of what their expectations are for those. So when we're looking at it from a financial strength standpoint, I mean, there's two primary numbers that they're looking at, which is working capital and tangible net worth. Working capital is your current asset base minus your current liabilities. They will make considerable adjustments to your financial to that number as well, including, for instance, accounts receivable over 90 days, depending on your inventory and how quickly that turns over. They may make an adjustment for that. Those things will really kind of bring that number down. They're trying to get the raw number on the working capital side because they will be leveraging that to support a facility. Tangible net worth. So this is kind of your retained earnings number with your share capital. We've had some changes to share capital in Ontario from an accounting standpoint in recent years, and so this is a critical piece too. The retained earnings piece is the most important, though. I mean, they're looking at are you retaining the profit that you're earning in your company? And if you aren't, where is that money going? Are you dividending out that money to shareholders? Is that staying within a holding company? Is that staying within the organization? Or is that money being pushed out to outside of the indemnity party that we had discussed earlier, right? So they're looking at that indemnity agreement as their catch-all from a loss standpoint. So they want to better understand, where that money's flowing, and if it's not staying in the operating company, where is it going? Again, that's a number that they'll leverage and push forward as they continue their review process. The review in itself, from a financial perspective, when they're setting up a new facility, they're going to be looking for 3 years of financials, CPA prepared financials, in addition to some in-house reporting, some current reporting. So say your year end was 6 months ago, they may be looking for that mid-year in-house financial statement so they can get a clear picture on that. Typically what we see on a go-forward basis could be semi-annual or quarterly reporting to the surety. That would be all in-house with that annual review provided by the accountant for the CPA. In addition to that, they're also looking at your track record, your project history, so completed work. They want to understand the scope, the size. They want to understand the profitability, the subcontractors that you utilized, the baseline for why you went after that project and what made that project successful. They'll be looking for quite a bit of information in that regard to kind of build their file, their understanding for what may be coming down the pipeline in the future, what opportunities you may be pursuing, who you may be working with, who you have good relationships with. And again, what that profitability looked like in the past on certain jobs. Management experience, they will be looking for, resumes, understanding the team that you have supporting not only the project pursuit side, the operational and finance side as well. It's a holistic approach of an organization that they're looking at just to ensure that all bases are covered from a financial aspect. It's critical, obviously, just noting the financial piece of the underwrite is so important. But the operational controls from the project standpoint, in addition to just the operation of the organization, are critical pieces in ensuring that the business is running smoothly. And again, It's about partnership. So they want to understand, how the organization is run and how they move forward. Current backlog and workload capacity. So what they'll be looking for here and on the backlog side of things is a work on hand report. So they want to see what you have on the go. And this will be again when you initiate a facility, but also a continual reporting structure on your facility terms and conditions, where they'll be asking for a work on hand report to assess your current backlog. So what projects you have currently on the go and how successfully those are running. They'll be looking for a full report on that. So they're looking for billings, cost to date. They'll be looking for profitability, profit earned to date as well. So there's a lot of metrics that are built out in that analysis to ensure that they're tracking those projects as they're bonded, right? So and that also just allows them to understand kind of where you are in your facility. So as we mentioned earlier, the facility runs very similar to a line of credit where you have an aggregate limit. So let's just call that $5 million. The surety gets a work on hand report, shows you've got about $2.5 million of cost to complete left on 5 or 6 projects. They're gonna take that number and utilize that to see how much facility you have left. Obviously, it's kind of easy math. You have 2.5 million in available capacity to support additional work. And the important part of that is, and we'll talk about it in a bit, just about how we leverage our facility further, is that number is so important to the surety, particularly when you're looking at new opportunities, when you're in a heavy bid season like we are right now, where there's a lot of work being let out, that you're able to ensure you have the capacity to support the projects that you want to pursue. So ensuring that the surety has the relevant information in a timely fashion allows them to make the best decisions for you and be able to support the business that you believe that you can support. So, sometimes we see a work on hand report, for instance, from some of our clients maybe once a year. It doesn't give us a clear picture of where they're at from a quarterly basis or a semi-annual basis, in order for us to make those adjustments to their capacity to ensure that they have adequate capacity to support their growth ambitions and their initiative to move forward. So we kind of chatted about this earlier, but it does act like a line of credit. It does allow for multiple projects to be bonded simultaneously. It doesn't tie up the cash or operating line of credit, as we mentioned as well. It's really off balance sheet, which is a great thing. The sureties like that. At the end of the day, though, I'll be honest, the sureties do like you to have a strong banking relationship. They do want to make sure that you do have a line of credit in place, and we'll chat about that a bit further in terms of how we can expand our facilities support and capacity. Improving our bond capacity. Obviously, I mean, it goes without saying, but to maintain strong financial statements, they're going to be looking at that working capital, that profitability, profit retention, that retained earning, profit retention, really building that financial position up in order to leverage support. Typically, the rule of thumb on the bottom side of things is, we have contractors that will qualify for a bond facility with as little as 250,000 in retained earnings and net worth and working capital, and they're able to leverage that number and push up slowly as that balance sheet continues to grow. I've had clients that have gone from 500,000 single and $1 million aggregate up to a $20 million facility. But those things take time. The balance sheet needs to grow. The experience aspect needs to grow as well. The understanding of job scope and project size, if that's increasing as well, need to ensure that you've got the right people, you're bringing in the right teams to support those endeavors and those engagements. And that's something that will obviously be considered as well in the underwriting process. Increasing that working capital, so focus on reducing debt, improving that AR turnover, and think of that as the operational financial aspect of it, where you're really focused on your AR turnover. Once ARs hit over 90 in the surety world, they're written off from a financial underwriting perspective. Obviously, they stay on your financials, but the surety is not considering that an asset anymore, as it's a hung receivable. So they're pushing that off your balance sheet. And inventory optimization again. Inventory sitting as a current asset. Is that turnover occurring? And what processes are we deploying to ensure our inventory is up to date, is accurate, Are we utilizing more of like a just-in-time service to ensure like the inventory that we're utilizing is assigned to projects? Then we can put more value, more weight into those numbers that we rely upon on the financial side of things. Demonstration of successfully completed projects. This is a critical piece. Surety companies, they love to see completed jobs. Obviously, from a risk standpoint, they know it's done. But I would always suggest if you have the opportunity to invite one of your underwriters out to a job site, get them to see the work that you've completed. I'll be touring 2 projects with my underwriters on one of my accounts next week. They really get a kick out of that. They really get to see kind of where the rubber meets the road, where the shovels hit the ground, and get to better understand your project. Get to see how you're navigating that project, and gain even a higher level of trust and confidence in your ability to complete the work. It really goes without saying. I think it's such a relationship-driven business that it's so critical to have a good relationship, not just with your broker, but your surety company as well. And again, that kind of goes into the next point there, which is the banking relationship side of things, which is a critical piece of this as well, where we're trying to not utilize the banking facility for letters of credit. And obviously, as a bonding broker myself, I'd certainly like to replace those with bonds whenever possible. But it's always critical to have that banking relationship in good health, ideally with a line of credit that's established and operational before you need it, right? I think there's always times where a line of credit is a necessary tool. It's a tool just like bonding, but if you don't need to use it, we've often seen that contractors will close their line of credit facility for lack of utilization. But what we've noticed from experience is, I mean, obviously it's very hard to get a facility when you need it. It's easier to get it and put it in place when things are on good terms. If you're in a critical pinch for capital, the banks may be less willing to extend capacity at that point. So it's always good to have that strong relationship in place. So the last 2 points there kind of speak for themselves. We kind of already touched on that. And the final one there, just on this slide, is work with an experienced surety broker, just to kind of put that in there as well. We have a exhaustive list of clients across Canada. We leverage that data not only to understand benchmarking for our clients, but where the market stands, how we're dealing with claims. It's a critical piece of the equation. Just like a good banker and accountant, your broker is a critical juncture in ensuring that your facility is adequate for the business that you're doing, not just for today, but for tomorrow. So that's a big aspect of it. When we're looking at financials again, and just to kind of hammer on this point one last time, we do need to optimize our financial presentation. When we're looking at financial statements, when we're getting reporting from our clients or from prospective clients, I can tell you that there is no equal sum from an accounting standpoint in the marketplace. Not all accountants are made equal, particularly when it comes to construction. Construction has a nuanced formula for financials that just doesn't always ring true with the accountants that are preparing them. There's a question that just came in. Can answer this real quick. I think it's Kevin's asked, how long does it normally take to evaluate a contractor once the surety company has all the appropriate paperwork to receive bonding acceptance? It's a good question, Kevin. We've been able to turn around facilities in a couple days once we have all the relevant information and that contractor qualifies. There are situations where, I've been working with a client now for about 6 months in order to get them into a position to qualify for surety. It's not always the case that the information that's presented right away qualifies you for surety, but we are there to kind of support you on that path forward in order to get your financials, get your operational controls in a position that the surety is now willing to extend support. If everything checks off and everything looks great, it can be done quite quickly. There are circumstances that always kind of tend to kind of put some nuance around the timeline on things. But once that indemnity agreement is signed, we're in a position to issue bonds right away. So it can be quite quick in itself. Just back to the financials. So as I mentioned, we have, I deal with contractors across Canada. Some work with CPAs that specialize in construction. Some are more generalist in nature. The quality of financials that we get, be it review engagement or audited or compilation, the actual content of those financials are irregular. I mean, you're not going to get a standard process from one accountant to the next. Certainly, there's different layers of financial reporting, and that's what I'm speaking to on the third point there, where there's actually three types of financial statements that you can request from an auditor. There's a compilation, a review engagement, and an audit financial statement, an audited financial statement. The level of scrutiny at the compilation, I mean, the name in itself just speaks to what the accountant does. He compiles the information, does not scrutinize the numbers, does not provide an audit on those numbers, is really just taking the information and presenting it in a compiled way to present to your bank, to your surety company. But it doesn't provide much assurance to the surety company that those numbers are completely valid, as the numbers haven't been tested, they haven't been scrutinized by the accountant. And it is a challenge for us in the surety market to get meaningful support for our clients if they are providing compilation-based statements. The general rule of thumb is the review engagement statement, which is just one layer up. And certainly these layers get more expensive as you go along. But the review engagement statement is kind of the standard requirement now in the marketplace. Particularly, I mean, if you're looking at if your top line revenue is over 5 million, it's very challenging for us to support an account with without a review engagement at the very least. The accountant does look into the numbers, does test the numbers, does provide a level of assurance to the surety company that's reviewing those statements that the numbers are accurate. And as we push forward into an audit, I mean, an audit is a considerable undertaking that we see from only really a handful of our clients. Some of the large national general contractors, large national subtrades that have extensive operations across Canada, they're looking for that audited statement as they're consolidating a lot of operational controls and reporting into one financial statement. They want to just make sure that level is accurate. But again, the audit comes with another additional price tag over the review engagement. It does get quite expensive. I would be focused primarily on the review engagement as a baseline. And within that, though, as I mentioned, the level of differentiation from our accountants, I would be focused on trying to find an accountant that does have that construction background, particularly the ones that understand work on hand, WIP reporting, because they want to incorporate those numbers into your financial statements and really give the surety company, also your bank, and you as an owner, the best information to make decisions on. So what we also see as companies grow is a question around revenue recognition. A lot of the time when we see companies initiate their operations, they're recognizing revenue on a completed contract basis or a cash basis. Sureties are focused on percentage of completion. This is, it speaks to what it is. If you're 25% complete the project, you're recognizing 25% of that revenue. And it just provides the sureties with a clear perspective on where things are at any given time. Again, clearly, this is also kind of tying into that work in hand report, where they're trying to understand exactly where you are on a project basis at any given time. So they're looking for accurate job costing, monitoring that gross profit margin. Again, looking at your cost to complete on your overall facility and overall backlog, so that they can then leverage your facility and ensure that you have enough capacity available to support new projects, but also to ensure that your facility matches your expectations from a revenue standpoint as your business continues to grow. Collateral requirements, I think we mentioned earlier, just with letters of credit being utilized, we want to try to sway away from that and utilize bonding, as it is off balance sheet. It does strengthen your balance sheet, increases that working capital position. It just makes the world a lot easier for us in the surety world to gain support and capacity. We do have scenarios as well if you do have a number of LCs in place on existing projects that we could look to replace those that are existing with a new bond. Obviously, the owner would have to be open and willing to accept that. But in a lot of circumstances, what we find is owners are open to that. They just weren't aware that was an option when they contracted with the contractor initially. And this more falls into the private sector where we do see some opportunity for replacement there. So how do you use bonding to grow? I mean, when we start looking at larger projects, when we start looking at larger opportunities, the requirement for bonding becomes more prevalent. When we're looking in Ontario, for instance, Anything in the public sector, if you're bidding as a prime, over 500,000 requires a bond, right? So if you're working below that threshold, we do still see bonding on public work below the 500,000. That's just the requirement under the Construction Act. But there are circumstances where public work is procured without bonding, for instance, below that 500,000 mark. If you're looking to grow into considerably larger projects, this is table stakes in certain jurisdictions that you're going to have to be able to put up bonding. I'd also suggest if you're looking to work with general contractors as a subcontractor, the larger your subcontract is, the more likelihood that they'll be looking for security from you as well. There are a number of different ways that could be structured. I have clients in the GC space that require bonds from their subcontractors in excess of 300,000, for instance. But there's also subcontractor default insurance with some of the larger players, the Birds, the Elstons of the world, they utilize instead of bonds, which require, again, another pre-qualification process, a financial qualification process for the subcontractor to undergo with those particular general contractors and their process. But in doing so, either you're qualified under SDI or bonding, you have the ability to then, look at these larger opportunities, grow your backlog, and look for opportunities for your organization to kind of take that next step. And it's the same really on the commercial side, right? I mean, if we're looking on the private side, we are starting to see those higher value contracts requiring security, particularly, snow clearing, landscape work, for commercial institutions and facilities. We're starting to see a push more into that sector, as well as condo boards. I'll tell you a story. I had one of my large clients sent in a bond request for a condominium over by Sherway, and I think the scope of the project was only 25,000. A very small project in itself, but they had required a bond on it. So that's an interesting size of a project to require support capacity for bonding on. But as I say, we're starting to see the utilization of bonding become more prevalent in the marketplace as owners, as condo boards, as the private sector gets to better understand the product. Key takeaways, right? I think it's quite clear. Bonding is essential to many large projects. If you're looking at it from a prime perspective, certainly, but as you're looking at it as a subcontractor or a supplier potentially, the likelihood of putting up bonds is growing. Contractors are looking for that level of confidence insurance from the people they're partnering with, that they'll be able to deliver on the obligation that they've set forth. And so just keep that in mind as we move forward. Question coming in. Can you get into costs at all? For sure. Yeah, it's a good question. Typically, your standard 50% performance and 50% labor material payment bond usually runs around 1% of contract price. That would be kind of the industry average, I would say. It is a credit product at the end of the day, so depending on the quality of your credit profile, those rates can go up, can go down. There's also some conditions around the bond wordings, the warranty period that is attached to that work. The duration of the project as well can enhance that, increase that rate as well. So there's quite a bit of variability that comes into it, but the rule of thumb for kind of a 1-year warranty, 12-month project, the rule of thumb is about 1% of contract price. And again, I think the next point here, just a strong, relationship with your bonding company, just to get back to that too, allowing your yeah, Kevin, that's a good point. There is an annual service fee typically tied to a facility as well. So if you think about it, all your bid bonds, your agreement to bond, pre-qualification letters that are issued, those do not have any premium attached to them. So, we have clients that require in excess of 1,000 bid bonds a year. There's no premium associated with that, although there is an administrative aspect to that we undertake here at Marsh. I have a team across Canada that supports us on the administrative side. So bond issuance, be it at the bid stage or the final bond stage, we do that all in-house. It doesn't happen at the surety level. And so that fee helps support both our costs related to that, but in addition to that, the underlying underwriting costs associated with the facility itself. So that's a nominal fee. I mean, it can range from $1,000 to, I mean, the highest I think I've seen recently is probably about $3,000. That's an annual fee that's charged in January. And just allows you to maintain that facility if you use it or not in accordance with the terms and conditions. So that would require the adequate reporting, be it the year-end reporting in addition to either quarterly or semi-annual reporting. So, but as I say, on the relationship side of things, it's very critical to have a good relationship both with the broker and the surety company. The more comfortable they get, not only with the financial aspect, but your performance will dictate your ability to as well, your broker to negotiate improved terms and conditions for your facility. So, a lot of the costing relating to projects is flow through. You want to incorporate those costs of bonding in your bid price to flow those costs through to the owner. And in doing so, I mean, we don't see much variability from a competitive standpoint when it relates to that. It's not as if we're seeing contractor A lose a job because he's paying more bond premium. We tend to see it more holistically. There's other factors in play for sure, but as a surety becomes more confident and familiar with your business, we have the ability to negotiate on your behalf to improve both terms and conditions. And when I say terms and conditions, that's everything from your facility limits to your rate, to your reporting covenants, your financial reporting requirements, and your indemnity agreement. So if your indemnity agreement is structured in a way right now that is quite far-reaching, if it includes personals, if it includes holding companies, in addition to the operating companies, is that necessary? That's something that we're always reviewing and looking out for our clients to ensure that they're not overly exposed from a personal standpoint or a corporate standpoint to the surety company. So that's a process that we undertake every year once we get the year-end financials to ensure that the alignment exists between the corporate risk standpoint, the surety risk, and where the business is going, right? So the business interest, the business plan, growth expectations for the year ahead. We're coming up to the end of the hour, so that kind of finishes up the presentation. Happy to open the floor to questions at this time. And my contact information was also on the one of the original slides of the presentation, so feel free to reach out to myself or Taylor directly if you do have any additional questions about the insurance program, our surety team, and how we may be able to support you and your business.
Thank you, Connor. I'm not seeing any questions. If anybody has anything, please add it either in the chat or in the questions and answers. At this time, I do want to say, Connor, thanks so much for the informative presentation. Your insights, strengthening the financial position, securing the right surety provides value to our members, and we appreciate that. The session has been recorded and it will be available soon. And if you'd like to learn more, as Connor mentioned, please reach out to either Connor, Taylor, the Marsh team, or our member services team. We're happy to assist.